tell you about it after.
Okay.
What's up, everyone? This is moving to Hawaii. Well, moving Hawaii. We rebranded the channel Moving Hawaii, moving to Hawaii. We might call it Moving to Hawaii again. We'll see. But I'm here with my lending partner, Jodie Tonga. We're going to talk about several things. As usual, stack your questions up. It's been a while since we did this live because I went on vacation and then Mahi went on vacation and Kenji was on vacation. It's been a while since we've done this, but put your questions in the comment section. If we don't get to it this week, we'll get to it next week. We love fielding your questions here live. And in the meantime, we can talk about rates, Jodie. Rates are, you corrected me when I was telling you, but aren't they like the worst they've been since their parents bought or something?
Yeah.
When were rates 8%?
They're the highest you said that they were the highest they've been in 23 years or something like that.
I said something.
And they did hit the highest that they've been in 23 years, probably on the end of last week. Yeah. They're a little bit better today. Just a little bit.
Went from 8.2 to 8.1.
No, but the costs associated with them. So it's not, it's the highest they've been in a long time.
Yeah, which means the affordability index is the worst it's been and since like the 50s or something, like pre-World War II or intra-World War II or something. Affordability is low, rates are bad. And I say that, so for the people at home and the people watching in post-play, I say that because we kind of pride ourselves in not this sugar-coated, real estate industry talk of like, no, let me explain why you should buy. You should always buy. Well, you should always be buying if you can. Like dollar cost averaging in stocks is always buying. And over time, you experience the market rise. So buying in general is good, but I just don't like that approach. So what do we think rates are going to do? It's confusing every time I talk to you and your brother. And it's like, but what I'm starting to learn, what I'm being conditioned to think is that if the economy keeps doing well, it gives them the ability to do this, right? The manipulation downwards, like lowering rates, would be a bailout and easing of some sorts because they've finally seen the cleansing in the economy that they were looking for.
Right. So if
the jobs report's good, we're just going to stay like this.
Kind of.
Yeah.
And it's not even that we're just going to stay like this. It's we haven't gotten to the baseline yet that they want to be at.
And what is that? Inflation numbers as it correlates to CPI, Consumer Price Index?
2%.
But we've seen that's gotten better and better and better, right?
It's year over year comparison improved.
Okay.
So June of this year compared to June of last year, June of last year was 8.2%, right? June of this year was 5 or something, right? So 5 is still not 2%. So even last month, 3.2 is not 2%.
Okay.
And this last
2%, just in case you're having a hard time following, talking about the Consumer Price Index representing 2%, not rates, not anything else.
Oh, right. So the cost of goods being 2% more than it was a year ago. Okay. That's where the Fed and that's where the nation, the government wants the inflation rate.
And so it's not because we've gotten to 3, they'll ease off. It's get to 2. But here's a question. What if we're at 2%? So inflation numbers are looking good, but jobs are strong and spending is strong. All these things are strong.
Then the cost of goods will increase.
So they're correlated. So there's no way jobs can be good, spending can be through the roof, and inflation can come down because they have an inverse relationship.
Well, correct. I mean, technically correct.
Okay.
But there is a term called immaculate disinflation.
Oh. Comment if you don't know what that means.
Which is where we are able to get to the inflation rate that we need to be at.
Okay.
Without a massive recession.
Okay.
Okay. So that is kind of what we're doing.
Has that happened in history? Here's the thing. I feel like, and I'm no macroeconomist. I don't have a degree in it. I pick up tidbits from smart people and I parrot it.
Mm-hmm.
But I feel like pre 2008,
Mm-hmm.
the government, the Federal Reserve, and therefore the government and the strings they would put on the economy, there weren't so many strings and they weren't as strong. They weren't so overlapping. They weren't in bed together. Like there were economic cycles that were more natural, if you will. Now it's kind of they're inexorably tied to one another.
Mm-hmm.
Yeah.
Yeah.
So
And
whatever
mm-hmm.
that word, whether it happened in the past or not, it would be unprecedented if it happened through direct manipulation. Probably, right?
Correct. Right. And what's happening is that everything is proving to be much more resilient than anyone anticipated.
Housing prices should be lower. Back to the point,
Right.
like back to this channel, real
Exactly.
estate. Housing, the house cost $1 million and rates are $1 million and rates are 2.5% for a VA and 3.25% for conventional. Then it goes to 7.5% for VA and 8.25% for conventional or whatever. That $1 million house should be worth like 600 or something. I don't know, a lot less.
Yeah.
But it's worth like 950.
Right.
Or something like
Right.
that. And so that is why the affordability index is so screwed. If that home were worth 500, like in 2009, the affordability index wasn't suffering. It was great.
Mm-hmm.
It's the opposite now.
Right.
Because things are so resilient. That's why hard, as we would say in Hawaii.
Right.
That's why hard.
And it's not just housing. So retail sales just came out last week.
Okay.
Tuesday. And those came out double anticipated.
Really?
Yes.
Because people created these spending habits in COVID, post-COVID especially.
Mm-hmm.
And that turning those habits, turning culture is like turning an aircraft carrier.
Right. But interestingly, one of the like consumer debt indexes, it decreased. So I'm sure people are still borrowing.
Really? I thought our consumer debt was just through the roof.
It was it's at an all-time high.
It is still very high,
It's
but
still,
it decreased by a little.
Yeah. And I was like, huh?
Is that because of defaults or payoff?
No, payoffs.
Okay, because I say if you know what I mean, it's kind of like jobs that people stopped working for greater than 6 months, so the job report's healthy.
Right.
If the debt report's healthy because people went bankrupt or defaulted on their loans, that's not a good thing.
Right. That's not a good thing.
Yeah, but that's not the case.
Correct. And so retail sales came out. Retail sales being more resilient than anticipated. After that, on that Tuesday, Wednesday rates were at an all-time high. That was the 23-year high.
Yeah.
And that's because it was anticipated to come out to 0.2 and it was like 0.59 or something percent, which is just people spending money. And just look left and right. I mean, whenever I go anywhere, I'm like, whoa, like people are spending money.
Yeah.
People are here. People are living. People are, like just go anywhere I ever go.
Yeah. Yeah.
So.
Yeah. The lines at Whole Foods are long.
They are.
We need them shorter, huh?
Right. Yeah.
You need short. If you want low rates, you need short lines at Whole Foods.
We need, yep. And I keep saying the same thing, and we're getting closer, but now the rate in which we were getting closer is slowing, right? So it's to get this last piece of the puzzle, it's going to it's not easy. But we need inflation at 2% and we need unemployment at 4%.
Wow. Wait, do we have any questions in the comment section? We got some? All right. I know that this loan stuff can be thick talk. For Jodie, it's second nature. She's smart and she deals with this stuff all the time. I know not everyone is like, what? CPI, PPI? What is all that? But the summary of that is the economy is too resilient and too strong. So they're all right. I'll raise the ante a bit more. I'll up it more until we either see inflation go down or immaculate conception or whatever Jodie said, whatever the de-emancipation, then rates are going to stay high unless inflation numbers come down. And I feel like even if they did, I feel like even if the inflation was down, if spending and all these things were going through the roof, they would just keep rates high. And they probably should, because it'd probably be unhealthy to go back to 2 or 3%.
Well, now, what I was going to say is it's kind of cool because now the government and the Fed, they really have a tool in their tool belt for if when the need comes, we're going to decrease rates.
The other thing that could cause a decrease in rates is the election cycle.
Right.
The powers that be, like a healthy economy in the fourth year of their term, especially in the second half of the fourth year of their term. When you're voting, I like you to think that the economy is doing good because of me if I'm the president.
And the economy is doing good. So it's funny. I was going to do a video the other day. I didn't get to it, but on this article that came out that just said like the economy is booming. And it's just like, you just don't expect to see an article like that coming out just saying the economy is booming.
Yeah.
But it is based on statistics.
Yeah. But it's like the context today is different than it's ever been.
Yeah.
So it's
because
like,
people are like, I can't make ends meet and I'm struggling to get by. I'm struggling to live at this my lifestyle, etc.
It's kind of like the Roaring 20s. Isn't this how the Roaring 20s was?
I think so.
Before people were like leaving their children with other families so they could go west and work, and just total poverty. It was dancing in the streets. After post World War I, right?
Yeah.
It was like post World War I, that frivolous, behavior in the streets. Everyone's spending, and then Great Depression.
Right.
And we have been quantitative easing for a long time. So the doomsdayer would say it's going to get terrible. It's going to get terrible. And I would say it could, but your brother actually said something to me that really hit. And it's not that the message, the point is so unique, but the way he said it hit me because I like being right. And he goes, sometimes bears are right. Sometimes bulls are right. Over time, one of them is always right. And that speaks to dollar cost averaging for those investors out there. It speaks to like, if you're always buying over time, in hindsight, you have always been right. You will have always been right. You have always won.
Right.
And so that's why, like, if you go to blogs like Mr. Money Mustache, they say just put money in the Vanguard Total Stock Market Index Fund and just don't think about it, because over time the market, like, we believe in America. So to your brother's point, now he has no kids, but he's like, I'm always a bull. I'm always buying. I'm always buying. Everyone's not in a position to do that, but what if it doesn't? What if we probably should have a Great Depression again, but we quantitative ease and like send trillions of dollars back into the economy and just like kick the can down the road? You'd rather have bought the house in December at an 8% rate than not, if that were the case. So anyways, there's a bunch of questions on that. A bunch of topics. We could go around that all day. Mandy Kehal, aloha Mandy, said, what is needed to obtain a DSCR loan, and how should one start the process? Well, start the process. Go to coreteamhawaii.com. Go to the top right. You can go book a call, or you can just go to the very bottom and go to Let's Talk, the very bottom of our page. And then my assistant, Charlotte, will ask you like 10 questions we have on this questionnaire, and then introduce you to Jodie's team. But other than that, how does one get started on a DSCR? Well, with any loan, it's like gather your taxes.
Right. So DSCR is a no income qualifier. And so it would be less about, we don't need taxes, we don't need W-2s, we don't need pay stubs. We do need assets. We need to see at least 20% down. We need to see at least a 680 FICO score. And that's pretty much it.
DSCR, Mandy, put in the comments, like, why are you looking at a DSCR? Because of bigger pockets and the like boom of the investor world, a lot of people are like, oh, I want to do a DSCR. I want to do a DSCR. And it's a great tool for the right situation, right?
Oh yeah, we're always going to see if you can qualify regularly first.
Yeah,
That's always better.
it's always better.
Unless you're going to flip in like less than 6 payments.
Because a DSCR, you could start out interest only. There's like creative things you
There
can do
is
with
an
it,
interest only component. There is a ARM component.
Oh yeah.
But but all of it is expensive
Mm-hmm.
because you're not qualifying based on a debt to income ratio. You're qualifying based on the property rent roll in comparison to your mortgage payment.
It's like debt to performance ratio. Yeah.
Debt service coverage ratio.
Yeah. Rambler, what's up? Aloha. Aloha. Had a crappy day at work, but your videos always bring me joy. Mahalo. One day I'll make it to Hawaii. Right on, Connor. Thank you. Appreciate
that's so
it.
Nice.
Playing devil's advocate. What if political pressure, Powell drops rates? I think we went over that since then. Like, yeah, fourth year of a presidency, that could be another reason why rates drop.
And if rates drop in our market, prices are gonna, I don't want to say skyrocket, but prices are gonna go up.
Let's talk about, I mean, we can talk about that because let's try and get our core team Hawaii thing back on the TV here. There we go. Pre-COVID, rates were stagnant for a year. Like the way you did business, you didn't have to put as much thought. The way the real estate industry was, I mean, of course, thought in all kinds of high level things, but in terms of rates, they were like 4.5, 4.75, 4 like for a long time.
Right. So it's not like we had to time anything, or it's not like we were up against like, dang, you didn't get us a contract for 2 days and now the buyer's paying $4,000 more.
Yeah. Like whereas like right now we're talking every time we're at a contract, sometimes you guys are like, we need it before the close of the business day. Like get it to us because rates are going to go up. Or it's like, hey, we opened escrow a week ago, but if we use our extension, we can move the buyer into a better rate because rates went down.
Right.
Times are different, but point is to that comment that I read, rates were stabilized at 4.5, 4.7, 4.5 to 5 forever. And then rates dropped to 3 overnight, like quickly, and the market went insane. Now, there are other circumstances with COVID. People wanted to move out of cities and into suburbs, out of suburbs and into the country, things of that nature. But
and remote.
And remote working became a thing.
born.
Just basically, I think of like a mason jar. Like it was shaken up, and then people were settled, and were like, well, "What do we do now? Like, what are the new decisions? How do we want to live our life?" So there's a lot of things that happened as a result of COVID, but the biggest thing is rates went from 5% to 3%, 4.7 to 3%, and that the stimulus that was into the economy was like an adrenaline, it was an epinephrine shot. So if things went from 8 to 5, like I'm very bullish on the Hawaii market. If things go from 8 to 5, extremely on any market, but especially in Hawaii.
Inventory will increase
because what sellers don't want to sell right now because they're like, man, at the peak, my home was worth $1 million. Now it's 950 or 930 or 970, whatever. I don't have to sell. But if rates were to come down to 5 and I waited for 6 to 9 or 12 months, then I'll sell. Then I'll go move to Colorado.
Right. And not only that, but it's like the exit, because they're like, well, shoot, I'm letting go of my 3% and I'm walking into an 8%.
Yes.
So there's that translation where they're like, is it worth it for me? Even though they want to, they desperately cannot live in their situation anymore. Like, I cannot walk upstairs. I'm sleeping in the living room. There is a house right now that's perfect for me, and I don't care. I'm still not selling. Like,
because
it's like,
I'm not walking away from a 2. Like some people are on 15-year loans at like 1.9.
Oh yeah.
They're not going to walk away from that.
So that's, definitely handcuffing a lot of people that would be selling right now.
But you're alluding to 2 reasons why we feel, I'll speak for you, but I think we feel confident about the Hawaii market and really the American housing market, and why it shouldn't crash is because For there to be a crash, there has to be an excess of supply. The reason why the market's so resilient is because there's a lack of supply. Why is there a lack of supply? Two main factors. People have more equity in their homes than ever, and people are locked into the best interest rates than ever.
Mhm.
So if you have $1 million home, you have 500,000 of equity because you put 300 down and 200 of it grew in equity or whatever, and appreciation. And of that 500 on your $1 million home, it's locked in at 2%. You don't want to sell for those reasons.
Right.
Yeah, you don't want to sell. And so
even in this market now, which you always talk about, Derek, which is buyers should have a little bit more power right now than they actually do.
Mhm.
And that's because of the lack of inventory.
Yeah.
That's it.
Yeah, it should 8% rates. The price is slightly suppressed. Like you think buyers would have more leverage. Occasionally they do. You see realtors all over Instagram where it's subsided a bit. 2-1 buy down. Let me teach you how to do a 2-1 buy down. And we do those things.
Yeah.
But you would think you'd have you could have 3 homes. They'd all be begging for you to buy their home.
Right.
But it's because there's such a lack of inventory.
Right.
In your opinion, I think I missed another question. Political pressure. Larry, how's it, Larry? In your opinion, is there a difference between what a home is worth and what it is appraised for? Depends. What was the appraisal for? Did dad just die? And so there's a date of death appraisal to establish the value at the date of death. Appraisers, they kind of know that you want that to be lower. And then when you go to the market, will it sell for more? Yes. However, in the state of Hawaii, if you offer on a home for $1 million and the appraiser is going out to appraise it, they get to see the contract. So they see, okay, Derek offered to buy Jodie's home for $1 million. Is that reasonable? And they're magically, they usually land on or somewhere near it, as long as it was a reasonable offer. Yeah. And so 5 appraisals for 5 different reasons at 5 different times, but close together, you'll get 5 different values.
Right.
So is there a difference? Yes. But for the purchase appraisal, they tend to be close. Sometimes they're short. So in the case of a VA loan, you get a Tidewater notice. They say, hey, you offered $1 million, but appraiser said only 970. So then buyer and seller have to talk.
But that's also a concept that's difficult to explain, perhaps to a buyer when it appraises for 600, but you, in order to win the deal, so all this always happened during COVID. Are the unicorn years? You had to offer 650.
Yes.
And you had to have an appraisal clause of 20K. These are just arbitrary numbers, right? Or 50. And so the reality is that the appraiser can only, for lending purposes, will only be able to use recent comparable sales. So it had to have sold recently. It has to be similar in specs, bedroom, bathroom size, land square footage, living square footage to the property you're buying. And so bottom line, if the most recent sale, if the neighbor's house across the street just sold for 600, even though you and 25 other people were willing to pay 650, one would have to argue that the market value of that property is 650. That doesn't mean the appraisal is going to come in at 650 because the appraiser has a job and has guidelines that he has to follow. And those guidelines are one of which is if the most recent sale is 600, he cannot justify 50K over. He can't even justify 20K over.
Yeah.
So
a good example of that. I was listing a home in Condo HOA, and Jodie's parents actually looked at that home. We were in contract for 1.3 million, 1.25 or 1.3. Anyway, I think maybe 1.25. My mark, I was going for 1.3. I was shooting for the stars, but 1.25 was still very healthy because the last comparable sold was like $1,050,000, almost identical home, but it's in an area that doesn't move a ton
ever.
And so since homes there, maybe like 1 or 2 sell in a year. And so for a like kind home to have sold and provided a good comp in that neighborhood. Just there wasn't one for years. So the appraiser was like 250,000 under or something like
Yeah.
that, or 150,000. The buyer still bought it because they were like, I get it. The appraiser can only use the most recent comps, which are too old to be relevant in this accelerating market.
Right.
So we're still willing to use our cash to close on this home.
Right.
So did they have to use more cash than 20% of the appraised value? Yes. So if they had to put 20 down and it only appraised at $1 million, that'd be 200. But if they're contractually obligated to 1.2, that's 240 that they have to put down plus closing costs. And so they had to use more cash than the minimum for the loan amount in order to close for the home. So yeah, appraisals, we like long answers. Appraisals and home values there can be a disparity for sure. Quantitative easing, Larry Tran. Quantitative easing and government spending during the pandemic was massive, and that's still an understatement. Consumer debt and auto loans are collapsing at an alarming rate. People are hurting bad. Larry, that's interesting. I know we've spoken, so you're smarter on this stuff than me. However, let's use foreclosures as an example. In a normal stabilized market, the way it had been pre-2008 forever, and even between like 2012 and 19, around like 0.8, 1% of loans are in foreclosure at any given time. Every 100 loans, one of them's in somewhere in the foreclosure stage. Home loans. During COVID, it was down to like 0.1, 0.2. And so if you're at 0.2 and you quadruple to 0.8, or you, whatever the word for 5 times, you 5x to 1% of loans being in foreclosure, that's just a return to normal.
Right.
I'm not saying that's all that's going on in the American economy. One of our clients, Robert and Joe, Robert works at American Express, and during 2021, 2022, he's like, we've never seen spending like this. Like at American Express, we are baffled by this spending. I text messaged him last week when we were all chatting, and he said, spending's come down a little bit and it's stable. And I said, what about defaults? Are they high? And he said, no, they're just normal. They've like returned to normal. So Larry, we'll take that for what it's worth. Lower level exec at American Express said spending has come down since COVID peaks as far as American Express's ecosystem. And then defaults, although up from forbearance times, are not abnormal. But I don't know the stats nationally. Shop talk is good to have and eventually elevates everyone's understanding. Thanks, Larry. Is it prudent to pay higher down payment or go with 5% with PMI? That's a good question, and there's not necessarily a simple answer. I would tend to tell you that if you have the 20% to avoid PMI, you should. I would tend to mostly always use that answer. What would you say?
I would tend to say whatever monthly payment that you are comfortable paying, decrease your down payment all the way to that monthly payment and keep the rest of the liquidity.
Yeah, Jodie and I differ on this.
Yep. I've shown this to many of our buyers. We'll create a 20% down scenario, and then I'll create a 10% down scenario, and then I might create a 5 or a 7 somewhere in between. And when they're doing the math and they're like, that's crazy. It's only,
I put $100,000 down,
right.
but my payment is not today. This is not today's interest rates, but past years. I put $100,000 down, but I'm only saving $450 per month, or
right.
Like that doesn't seem like it's worth it.
Right.
Yeah.
And they're almost offended by it. And they're like, and I'm like, if you feel like your money is worth more than that type of incremental increase in your monthly payment, I think you should keep your money.
Whereas I disagree with Jodie. I'm more Dave Ramsey on this, because I'm not so sure you're not going to go to Breckenridge and get a suite and order room service. Because you might do that with 100,000 laying around in your bank account.
And we do talk about that. We talk about, what are you going to do with that money? Where is that money better spent? Where is that money better invested? Where, and then they're like, well, come to think of it, it'd probably be better if we are able to have for our new furniture, or we did want to renovate one of the bathrooms or whatever, and so up to the point of affordability, I think that's a smart leverage.
Okay. And that's good. That's why we love this channel, because I'm a little more Dave Ramsey on that. Jodie's a little less. However, just like Dave does, Dave would never admit this, but just like Dave, if I speak to you on the side and I know you're gonna go and invest in like a limited partnership in multifamily, and then you're gonna hedge with this, and you're gonna diversify your portfolio and rebalance it every month, and then I'm like, yeah, leverage more. You should, and you could. If you could, you should. But I just don't think most people are that. Even me, I am not as diligent as I should be with my money. So, all right. Yes, I have the DSCR person, Mandy Kihal. I have a 815 credit score and great equity. I just don't have a W-2 as I'm self-employed. So I have the down payment and equity and a great credit score. Would like to use my equity in an investment property and use the money that I get from the rent towards the loan. The thing is, Mandy, there's just better places to get cash flow than Hawaii. We're not typically the best. And so if you're looking to use a DSCR, your DSCR goes further in other markets to cash flow better. So if you're buying 500,000 in Arkansas and it's a multifamily or something, but then you're buying 500,000 here, you're going to have to put way more down here than in Arkansas because the cash flow is inferior here, right?
Mm-hmm. But if you want to increase your real estate portfolio in Hawaii because you have, let's say, kids, and you're like, well, I have 2 kids and I want to have 2 properties, or whatever it is, I have 2 grandkids and I want to have 2 properties, right? Then some people want to invest in Hawaii specifically.
Sure. Yeah. And I talk to people all the time, especially when people are calling in. It's like, hey, I want to do an Airbnb. I always challenge them, because they're like, well, I come there once a year and I could stay in my Airbnb. And I'm like, the tax savings you get on that trip are de minimis, and go somewhere with better cash flow, and go to Waikiki and have them change your sheets and put a mint on your pillow every night. You don't need an Airbnb here to enjoy Hawaii. Mm-hmm. And people sometimes they're like, wow, kind of negative for someone who's supposed to be earning commissions. But I just want to be real with you guys. But if it's the right play, like someone that exact scenario from like San Ramon, California came in this week, and he's like, yeah, but I also kind of just want a place in Hawaii because we might want to retire there. So it's a hedge against retirement for us. And I'm like, okay, well, that's a different reason.
Right.
Let's talk about that. So, all right. What other questions we have? We are probably going to move towards wrapping this one up if we don't get more questions from you guys. You know what? Before I'm going to say that, give us some questions. In the meantime, I'm going to do a little plug for our website. So if you go to our website, and I got our web designer to do this for us. They had not done it for anyone. And then they do it. No one else in Hawaii has this, but they've done it for some other cities across the country because we innovated with them. You may not know that this is interactive. We should probably put some sort of badge, like click on the islands.
Yeah.
So if you click Oahu being, the most common. So if you click, there's actually videos from Mahe and I talking about each area. So these aren't on the YouTube. These aren't anywhere else. They're only here. And so if you're like, what about Waikiki? What about Hawaii Kai? What about Hawaii Kai versus Kailua? Let's see what they say. You can click on those neighborhoods and we talk about it. Excuse me. Most of those videos are like 2-3 minutes, maybe 4 minutes at the longest. So that's another fun place to go play around if you're wondering about the different islands. I haven't watched this Maui one in a long time. It was pre-fire, but I'm sure we don't say anything offensive. but yeah, and there's one for the outer islands as well. All right, what questions do we have? Aloha. So I have a down payment equity. Aloha, my wife and I currently live on Kauai. We will be moving to either Ewa Beach or Mililani next month for work. Love your videos. Been watching you guys for 2 years. Moved from Michigan. Wilson, thank you. If you guys are gonna buy a home, please hit us up. You know what, too? I'm gonna say that too. Like, reach out to us. We want to help you in real estate. We want to be the very first people you think of when you think about real estate in Hawaii. I was at the food truck event at Pro Ridge, and this guy stopped me. He's like, "Hey man, I just want to let you know, love your videos, love your channel. Like, I got all my information for buy. I bought a place, and I was happy. I'm happy for him. Congratulations, you
Right.
know." Also, I always have to ask, how come you didn't hit us up? And his biggest thing is he's like, I don't know. I guess I kind of didn't think I could. Like, you're kind of like this TV star thing. And I'm like, no, bro, hit us up. The other thing is he had already, I think, started working with someone before he saw the videos and they didn't suck. So there's that too. But yeah, reach out to us. Go to our website. Are there any updates on the state of Hawaii or on the state of the 90-day short-term rental minimum? Haven't heard much on it recently. Oh, Larry, I missed one from you. I'll get that next. So I own a 30-day rental in a place that is zoned mixed resort residential, inland Ko'olina. So actually, let me put the map here. So there are basically 3 resort areas on the island. There's Waikiki. Not all of Waikiki can short-term rent, but there's Waikiki where there's some short-term renting. There's Ko'olina where there's some really one short-term renting, and then there's Turtle Bay. In Ko'olina, so if this were a real estate map, there'd be parcels. There'd be like rectangles and triangles everywhere of parcels, right? Along the beach, it's zoned resort. That's why Hilton can build there and Marriott can build there and be there and operate there. Just inland from these lagoons, just across the street, like where the restaurants are across the street, that's zoned residential / resort. It's mixed zoning. And so even that Bill 41 that you're referring to allowed for 30 days in those areas. Now, the HOA can supersede that. The HOA can say 6-month minimum, but the city's bill said 30 days. So I own inland here where we can do 30. The 90-day thing, don't take this for gospel. Last I understood, it went to the state Supreme Court, I believe, and it was deemed unconstitutional to enforce 90 days. So unless your HOA says 90 days or 6 months or whatever, 30 days is the maximum or the maximum minimum that can be enforced. That sounds weird, but 30 days can be enforced. I'm not so sure that they can enforce 90. So you see people doing 30-day rentals all over the island, but not less than. And with those 30 days, that still falls under, you should have the TAT tax, the TVU license, and all that stuff. We as a 30-day landlord still do those extra tax things. So yeah, I think where it stands is, although the city and probably the Hilton attorneys and Aston attorneys and stuff who wrote that bill and pushed it through the government, that's what a friend said, not me, would like it to be 90, but I think 30 days is the most you can enforce. Feel free to leave a comment and say, Derek, you're wrong. Here's an article on Google. Yeah. Larry said, can you shed some light on why all of the homes in Coral Ridge have air filters on every window? Oh, yeah, Larry, it's just dirty. That's why. In Hawaii, construction, red dirt. There's just living in Coral Ridge right now. That's a good point. It's just dirty. I lived in Eva Gentry when they were building new, and I was a young man. My parents had just bought a home. I had a black Mustang, and I'd wash it every single day. It would just be so dirty because it was new construction.
Yeah, like literal dirt.
Yeah, construction people puffing up dirt, and it's windy in the middle of the island too, right? Yep. So that's why that. And Waipio is a place more where they're like, hey, we'd like to open our windows, so now we'll do so with air filters. Whereas Eva was like, no, we got central air conditioning for a reason.
Yep.
Aloha, love your vids. Thank you. Me and my girlfriend are a young couple looking to make the move to the Big Island as soon as she finishes nursing school. We absolutely love your videos and find these streams very helpful. Cole, congratulations on nursing and the relationship. Awesome job. Let me know in the comments where you're from. Yes, Jodie is correct. I have kids here and don't have the manpower to pay a team elsewhere. I like the Hawaii market because it's almost a guarantee, and I figure build here slowly, then elsewhere faster. Mandy, perfect. Let's do it. Hit us up. Uh, a lot of the people on this channel aren't here, and so the play is different. 100% if you're in Hawaii, like for one, on the mainland, you have to pay a property manager, whereas you could self-manage here. And two, there's just a comfort level of like you can send your handyman or your cousin instead of whatever the property manager is doing. We would definitely come to you guys when we were ready to make a purchase on Oahu for sure. Right on, Wilson. Thank you. Which island do you see the best long-term gains? I've been renting on Maui for 10 years. I think I don't know. I've never pulled statistics. I don't know if over time there's a huge disparity between the islands. But what I would say is if you can get in pre-construction and new construction in certain areas, you could get unique gains. So in Poipu, there was this new development. It was like the last one for a long time. And these people bought for like 800 and they're selling for closer to like 1.8 and within like a 3-year span. There's unique opportunities like that. Not so much on Oahu though.
Right. We love the Big Island.
Yeah. We say we. Is it like me and you or?
We.
I like the Big Island. Yeah.
Yeah. We and my family also.
Yeah.
I do think that you can get more. Your dollar goes farther.
Certainly goes farther. But
on the Big Island.
On a percentage gain, is it more, you think, over time?
I do think that there's going to be a lot more development on the Big Island and that it's going to catch up to Oahu. Not necessarily catch up to Oahu where it's like, okay, you're going to have not talking about the outliers. I'm just talking about like, a standard single family home.
Yeah.
And I do think that those, if you can get in earlier now, it's like, it would be like buying, 10 or 20 years ago on Oahu. So
potentially, yeah. Mm-hmm. Yeah, for sure. There's more of the islands, like what is going to experience the kind of economic development that say, because like you want to get into Nashville before it booms, Austin before it booms. That ship sailed everywhere else. And so Big Island would be the place where you could place that bet.
Right.
Yeah, for sure.
And there are a lot of, local people that live on Oahu that are moving to the Big Island.
Yeah. FYI, shout out to Kenny for his quick responses and candid and honest answers to my questions when I was on island a week ago. And Charlotte too. You have her major working on that phone. Love the videos in general. I don't know if I should finish this one, Michael. I don't want to gas her up too much. Love the videos in general and like the ones with Jodie a lot.
Oh, thank you.
Michael's a longtime viewer. Hey, Derek, it's been a year since your Ko'olina investment video. Are you still seeing profit? Philip, I don't cash flow that well. By the time we pay Airbnb, short-term rental tax, or medium-term transitional vacation unit taxes, occasionally, like we have to fix the air conditioner, so capital expenditures. It doesn't cash flow that strong. And then there's times of the year. So last fall, we had just got it and we attributed it to being like new on the platforms and stuff. We didn't rent well in the fall. This fall, then Maui happened and we didn't rent as strong either. We're slightly profitable. Quite honestly, if it's like my first investment ever and I live in Texas and I'm trying to build my wealth and I'm trying to, like, I don't go to Ko'olina for that. Now, there's plenty of reasons to go to Ko'olina. I just don't cash flow the best. But for me, as a real estate professional, we can do cost segregation and depreciation so we can save money on taxes as a real estate professional in the tax code. And I've also seen appreciation. So that thing's gone up like $100,000 since I bought it a year and a half ago. And that's pretty good. So there's that. But in terms of cash flow month to month, not the greatest. But again, it's not timing the market, it's time in the market. And if I own this thing in 10 years, I'll be cash flowing handsomely because all that will have gone up. I will have refied. I could, all sorts of things. Buy we like to get technical, Jody and I, Pacific Rim and I, but quite simply, 80% of it is buy real estate and wait. And then that works. All right. We'll start moving towards a close. We're from Chicago. Definitely don't recommend the cold here. I agree. Couldn't justify going to anyone else after watching you guys for so long. You guys are part of the reason why we want to be in Oahu. Oh, nice Okina too, between the O and A. So we come to you when we're ready to buy for sure. Thank you. I agree on Big Island, Adam says. I have a small condo in Waimea that I bought in 2019. I've been offered almost double for it. Not selling, though I love it. Well, a couple of things about that. One, 2019 was it was great timing. But and two, Waimea is amazing. You like Waimea?
Love Waimea.
It's so amazing. It's cold mountain town. And you don't have to liquidate the wealth and sell it for it to benefit you, right? So you can leverage it, you can collateralize it. If you want to get sophisticated, just keep owning it, keep letting that tree grow, but harvest the fruits and go buy something else or whatever. Just don't buy Snickers bars and vacations with your house money. I just got my real estate license and hoping to buy my first home. What is your advice for first-time buyers? Should we save up for 20% down or say 5 to 10% and pull the trigger on a home? Handle that, 808. Hey, handle that. I know you're from Hawaii, 808. So hit me up on Instagram. Add me on Instagram. Let's keep in touch. You don't need to join me in my team or my brokerage, but I'll help you. We'll chat. But Jody, I think you and I'll actually agree on this one because you're not saying that they have the 20%. They're saying, should we buy with 5 or 10 and get started?
Yes.
What would you say?
Yes.
Okay. What?
ASAP.
There's a lender that is doing 5% down, no PMI.
Well, there is
certain programs.
Mm-hmm. There's a lender paid MI where there's no monthly private mortgage insurance. I did hear of a lender that might be doing a no PMI, but that's at a higher interest rate. Mm-hmm. So apples to apples, when we really break it down and compare it to our version of it, which would be a lender paid MI is what we call it, which is when there's no monthly private mortgage insurance. It usually works out better than the higher rate just because our rate is lower. Mm-hmm. And then also I'm still going to go back to the monthly because I love monthly PMI because it's going to fall off once the necessary equity has been gained. So why would you want to have a higher interest rate? Yeah. Which now there is an argument to that because we do know that we're all going to be refinancing in the future.
But what if he can't, what if he gets an inheritance? Mm-hmm. I'm assuming handle that is a male. So excuse me if I'm wrong. But what if he gets an inheritance and has the money to move into a no PMI situation, but rates are still high? That would suck. So,
right.
So and a couple of things I want to clarify. When you say I know a lender, Jody is the lender, but because she's a mortgage broker, not a banker, not that she just has to do loans to one entity, they go out and shop and get you the loan at the best place. She says she knows a lender. She's talking an upline, past her, there's other lenders. So, and another thing about that, you can't go directly to those lenders and get a better deal because of their volume and the relationship. I couldn't. I can't go to Rocket Mortgage and do better than Jody can do for me at Rocket Mortgage. So why skip the service, the reputation? It just doesn't make sense. So when she's saying I know of a lender, it's one of the many lines of credit you could
a wholesale channel.
Wholesale channel.
I'll say that from now on.
Yeah. So let's give a monetary example. So say it's $1,000 a month. That'd be way more in Hawaii, but it's $1,000 a month payment and $200 PMI versus a $1,200 a month payment.
Right.
You'd rather the 200 PMI because it drops off.
Yes.
Whereas a $1,200 a month payment, it only drops off when you're in a position to refi, but refis are not cheap, especially they're a little cheaper with VA loans, but they cost money when you go to refi. So,
yeah, I mean, like, $8,000.
yeah. So have the PMI that drops off.
Right.
So this
So
is the
I
nuance.
love borrower paid monthly private mortgage insurance because, and I'll always like, we'll still go through all the comparisons and like literally break it down and figure out why, right? Why someone is like, I want the one with no PMI. Right?
Yeah.
So you want like 0.75% higher in rate.
Yeah.
Just so you can say that you don't have private mortgage insurance,
Yeah.
So, but there are, there's no wrong answer. So
It's like, do you want to strap on a 5-pound weight to go up a cocoa head, or do you want to be 5 pounds fatter? Like, I already have enough fat to deal with, so I don't have a weight that I can take off, at a certain point. PMI might be the better option. Sounds like oftentimes it is when you're running the numbers.
Yep.
I love this nuance. I hear like, you're not a real estate professional and a lender and all those things. So we don't expect you to like speak in micro nuance. Like that's for us. So I love this stuff. I agree on big on it. I got my real estate license. Moving to Hawaii, and I'm doing some research on apartments. Seems to be a lot of insider knowledge and rumors about certain apartments with terrible HOAs hiding certain things. When you say apartments, I think rentals, because you can only rent apartments, you can't buy them. So I think you're referring to buying a condo. And yes, HOAs, you stack up 5 buildings. If they're 5 different HOAs, 5 different experiences, even if the floor plan is the same on every one. We're just in a deal recently where the budget's mismanaged, the reserves aren't good, like just all kinds of stuff with the HOA.
And a lot of stuff is like, it's not necessarily always the case of where they're hiding it versus just like lack of knowledge. Just like they just didn't know. Yeah, poor management. And so boards will take over and then they'll decide to switch management companies. Then the new management company is like, you guys are crap. Like you don't even know how bad this is, right? And so it's a lot of times and even one level above that is a lot of times as the unit owner, the board may be aware of it and you may be getting communicated to, but as a unit owner, you just have no idea. You don't know. And it's because you missed the email. You didn't go to the board meeting. You didn't open up that letter that says proxy. Like you're like, it's nothing. It's junk mail. But actually there's some important information in it. So
yeah. And it might be, so Jodie speaks in terms of that. So like finances, compliance, because that's what your lender does. If I had $1 million cash, I'd want to get like a $1 loan just so I could get underwriting and Jodie's team to just look through everything. So that's a value in having a lender. Also a value in having a lender that does volume and a team that does volume. Like we do large volume. Jodie does even larger volume because just that's the nature of a productive lender because they work with other agents than just us. And so that means they've reviewed more HOA docs. They've seen more scenarios just by scale of things. It may not be compliance. The money, like building A and building B might have good money, but building A is like super Karen-y,
right.
Or the male version of a Karen, like HOA police. It does vary building to building. It's very true. I'm doing some research. There's a lender that's doing 5% down, no PMI. Yeah, you had mentioned that earlier, but 5% down, no PMI, the house gets paid. You go to Vegas, like, oh, they pay out 99% on this slot. Well, house gets paid. Roulette, red and black, but except for there's 2 greens. Like statistically, the house is going to get paid. If there's no PMI, the rate's higher, the closing costs are higher. Like these gazillionaire conglomerates aren't designed to lose money. So no PMI might be the better thing. PMI might be the better thing. We'll be messaging you when I'm on island. How do I know who to trust? Would my real estate agent tell me this? It depends, John. Depends on the building. I'll be as real with you as it gets. I don't think there's another agent who's more real. maybe equivalent, but not more. I haven't lived in every building on the island, so we can't know everything. But I don't know if I'm buying a condo and I'm worried about that on the finance and compliance side. Yeah, we're gonna look at that. There is a third party like attorney review can review docs for you, but that's why it's good to have a loan because underwriting, the risk management department, they look at this and they can't give you the loan if reserves aren't good. They're not managing their books good, not keeping their minutes. In terms of like the climate and how caring it is, I could go hang around and talk to people walking their dog outside. I think is probably the best, unless it's a building we know really well. I know of a place where I own a condo, and that's not. I would tell you about that one because I have firsthand experience. Actually, it hasn't affected me, but there's some real politics that go on in there that I'm glad I don't have to get a part of. You know, be a part
And
of.
I also have experienced that, being one of the youngest unit owners in this
Oh, yeah.
one in town, and
Yeah.
they were like watching us like every single thing, and we were the only ones getting the citations. Nobody else was
Really?
getting.
At
And
exec?
it was no,
Yeah.
not exec.
Oh, wasn't exec?
Date Street, Terrace Towers.
Oh, yeah.
Terrace Towers. Yeah, and it was a real thing, and we literally bought our first house as a result of this HOA.
Because you had to get out.
Because they were picking on us.
Was Shane living? I
Yeah.
can't see Shane dealing with that.
He didn't.
I can't see
And
Shane
he was
dealing with
like,
that.
and it was like more and more. And eventually it was, I got them to literally waive everything, but it was over $5,000 in like fines
Oh,
due to whatever, being parked for more than 3 minutes in the loading zone, or our dog wasn't completely off property before she used the bathroom, or like just like little things. I'm like,
just
we had
irritating.
so many pictures of other people's dogs using the bathroom on property. And I'm like, really? She's right there on the like grass, just like little things like that. But that was, and I didn't know. And it was one of the only 3 bedrooms for sale on the market at the time that I wanted a 3-bedroom.
Yeah.
And it was just a whole bunch of old people.
Yeah, yeah. Well,
and they were like, what is this 22-year-old doing living with us? Like, it's basically a retirement home, but it's not really. But
yeah, I got you.
But it was.
Where I own in I'll just call a spade. I don't know that there's a high probability that they will never see this. I hope so. I don't want problems. But one of the HOA board members, or was a board member, they have a Ring camera recording of the person going up to someone else's unit, trying to open their garage, attached but outside garage. So trying to open their garage, smoke their cigarette, throw it down in the bushes, and they're like, "Come on, Scruffy," with their dog. They're not here. We'll come back later. And I'm like, bruh, like you're not supposed to be like, you're breaking all these rules. So it can be bad. And if we knew that, I would tell you. I try to be objective and not subjective, but if we had personal experience, we'd 100% tell you. If we could reach into our network and get secondhand experience, we'd tell you. But we also can't know everything, It's just
right.
Michael said interest is deductible, OI is not. I think PMI is what he means, but okay. Well, in that example,
But there's a cap.
There's a cap on interest rate deduction.
On mortgage interest deduction. And then PMI is deductible if you're making less than a certain amount of money.
Oh, cool.
It's around 130,000. I have to
check and that. Let's say you're at a 25% tax bracket and it's, you could do the math and it's blank over time and blah, blah, blah. And so like, okay, opportunity costs, someone in this example might have missed out on PMI deduction or interest rate deduction, theoretically. Well, they wouldn't though, because PMI is deductible is what you're saying. But even if they were, but then let's say they were in a situation where the PMI didn't drop off, they forgot about it, or rates were bad, or whatever, they had to refi for $8,000. Like there's a lot of expenses associated with the higher rate. So I'd probably still opt for the PMI between those two scenarios. How much is the broker service? I am people have been asking this. I don't know what the broker service means. So on the seller's agent side, the way things go right now, the seller and the seller's agent figure out the commission, and then the selling side cooperates with our side. So then there's, you don't directly pay me anything or my brokerage anything. There's some litigation around this and national news and stuff. So the reason why I'm being long-winded and hesitant to answer directly is because it might change in the future. I don't want to misspeak. Buyers agents go around saying my service is free. It's like, well, kind of, but like you buy the $1 million house, the seller gets the $1 million. Oh shoot. Seller gets that money and then they give it to the selling brokers and the brokerage gives it to me. And so like but I don't send you an invoice. I can say that. I don't send you it right now. In the future, the industry could change, and that's how that could be. If you're selling your home with us, I will say I look at each scenario and it has to make business sense. People are like, what do you mean? You'd overcharge me? Well, I mean, if you need me to manage your remodel and do the landscaping and do a ton of stuff, maybe more than the standard, maybe more than the 6% average commission. If you're like, Derek, it's all perfect. I'm a flipper. I know it's worth $1 million, but I got to get liquid. I need to sell it for 900, list it, go. Will you charge me less than the standard? Like, yeah, okay, we'll sell it tomorrow for 900. So always look at what makes business sense. Sometimes our clients like move here and then have to leave 6 months later. Oftentimes I'll help them a little. We just earned together. And I want to protect them. So it just depends. But on the buyer side, I don't send you an invoice for anything. All right, I'm going to answer. Jodie and I are going to address one or two, and then we're going to wrap this up. Thank you for answering. Of course, John. Larry Tran, Jodie, your experience is just what I experienced, and that's the reason why I joined my HOA board and put my foot down and knocked that kind of poop emoji out. Knock that kind of shit out. Handle that said it's Navy Federal Credit Union.
Yeah, so the rates are way higher.
Yeah. So
that's all.
From the horse's mouth. Anytime we've competed, we being Jodie's team, my preferred lender with Navy Fed, they've never lost.
And it's by far, like it's not close.
There have been situations where the person was forever under the impression that you had lost until time went by and they go, oh, the fees are different than I perceived them to be.
Right.
Yeah. Navy Fed does a great job with marketing.
Oh, yeah.
Like the way they present it, like, today's like it looks really good. But you have to issue a loan estimate. Like there's, what is it, 17 CFR? Or there's a code of federal regulations that governs the way they do business. They're way more heavily regulated than our side. And once certain elements exist, a loan estimate has to be issued. And it has to say your interest rate and your payment and
your points, your origination fee.
And Navy Fed has an origination fee.
Yes. And we don't.
Yeah.
And so if you're thinking you're getting like 7.25 at 0 points, but actually it's a 7.25 at 1 point, and you're comparing it to our real 0 point scenario. So it's not an apples to apples comparison.
Can you call fees anything you want in the lending world?
No.
You call it origination fee, convenience fee.
No.
Friday fee,
no.
Aloha fee.
No.
But there's a fee.
It's a fee. It's an origination fee, which is box A of the loan estimate. Now you can include other fees in box A, such as an underwriting fee or a processing fee. But other than that, origination, underwriting, and processing, there's not much more and points, of course, and points. There's not much more that you can like call it.
So are you telling me Brada Handle that who just got his license and is trying to buy, if he came to you, you would beat Navy Fed?
Yes.
Easy. So hit us up.
Easily.
Yeah, hit us up. I love to meet people in the industry, especially cool ones. So yeah, I'll connect you with Jodie. You can hit Jodie up directly, whatever. Let's see. And we'll report back to this channel.
Yeah.
Did she win? She always has when we've, because we deal with a lot of veterans, and
Mhm.
there's this affinity to USAA and Navy Fed. USAA is never in the mortgage conversation. They're expensive. Good customer service are expensive on insurance and stuff like that. Navy Fed, great job with marketing, and a lot of people have like bought their last home with Navy Fed.
Right.
But when they do a comprehensive comparison, that they never lose. So like, why not have a? And as selling agents, we don't prefer to see Navy
Right.
Fed. They've gotten better. We have closed ones with Navy Fed, but we prefer to see one of the handful of local lenders on the island who we know are going to be more communicative, and it's going to be this time zone Friday afternoon and things like that.
And it's also, they will struggle with the timeline. They'll struggle.
I've closed a Navy Fed on time, fine.
30 days.
Yeah, I have.
Really?
In more recent times, yeah.
Good.
But
good
the
for
fact
them.
that reputation is out there means something, right?
Mhm.
I just want to be objective. I have Pacific Rim is better, like better rate, local reputation, strong team, working in tandem with us. Like there's no reason not to if your monthly payment's going to be lower and your closing costs and like that whole lender estimate, the loan estimate thing is better. There's no reason not to. There's no reason not to. All right. I think I can wrap. Got hit, Leslie. I know your team's itching to get you. So you could exit
I know.
stage left if
Okay.
you need to.
Okay.
Yeah. But
we
let me do one more. All right. Aloha. Currently out Laie area. Wanted to move closer to Kahalu'u Kane'ohe area 2025-ish. We were looking to buy Kahalu'u in 2017, but no inventory. You foresee houses, 850K homes available around 2025? No. Single family in Kahalu'u, like you could get, I doubt 850, but like 900s. Kahalu'u, not Kane'ohe, really, for 900, but Kahalu'u. And for the people, this person is A'ala Kapua. So I know you, local. How's it? But for the people on the mainland, like, what are they talking about? Kahalu'u, Kane'ohe. Kane'ohe is a certain thing, and like Aiden and I were driving like Hui'iwa-ish, like Kahalu'u adjacent border, and I was like, "Are we Kahalu'u or Kane'ohe right now, technically?" And I forget if he made the comment or I made the comment, but we're like, Kahalu'u's get a little bit more chicken coops, right? So Kahalu'u just has a more country local vibe, and so the prices in Kahalu'u slightly lower. Now there's waterfront that's different, but 850 though, that's a stretch. I think in the nines is like best case scenario, and still probably north of $1 million for the most part for single family. And Kahalu'u doesn't really have. So I'm like turning on Pigeon because I know it's a local person. Kahalu'u doesn't really have. I mean, there's townhomes. There's townhome areas like Hui'iwa, Huikelu, like Huimanu, Kalu, and then there's some more townhomes. But single family 850, no, not really, unfortunately.
950.
950 Kalu.
It's gonna be the best, and that's gonna be
like no
original.
yard.
Yeah, that's gonna be small. It's gonna be as originally built, probably ready for a remodel.
Yeah. All right, Larry, I saw your last comment. Aloha. If you guys are watching this after the fact, stack us up with questions. We'll address them on the next one. Go to coreteamhawaii.com. You go to buy and get pre-qualified. I don't actually pre-qualify you. We're going to introduce you to Jodie.
What happens when you go to get pre-qualified?
We have a video on it talking about it. And then...
Oh, my information should be
and
there.
then we want you to we want you to connect with us first. That's why Jodie's information is not there. Want you to connect with us, and then like I said, our assistant fills out a 10-question questionnaire, makes all the intros, and we have a whole process.
Don't forget about that one idea on the map. Don't forget about the one idea on the map. That's a good idea.
To let them know it's interactive.
Yeah. Like an arrow, a blinking arrow or something like that.
Yeah. And then we have some other stuff. For the most part, we don't build, like you can go buy search homes. And I think actually I already brought it up. It's right here. We have our own search function. We're not trying to capture you on the allure of we have the, this home search tool. We have it and it's great and it's ours. Excuse me. But this is mainly, for you to come in and confirm we're the people from YouTube, and we have a nice website and we're very helpful, and call us, book a call, or go to the very bottom and fill out your info and my assistant will reach out. Thank you guys.